Welcome to another episode of the Capital Spotlight. Today we have Aaron Kurlansky from FM Capital. Thanks for being on.
My pleasure.
So to start, please share some information on your background as well as what you're focused on at FM.
Sure. So we started in 2009 by buying non-performing commercial debt. We pretty much bought about $3 billion in debt since '09. I would say simultaneously, starting in about 2011, we started buying multifamily apartments in the Southeast. We pretty much, we're up to about 25,000 units in about 2015, 2016. Right now we have about 5,000 or so units still under management. And our primary focus these days is in the form of a lender. We've been bridge lending for the last couple of years. We took a little pause when COVID hit, but now we've resumed lending in the last month or so, and we've been closing deals.
That's exciting. Yeah, definitely lots to talk about on the credit versus equity side, and what's going on in the market today. So we'll get in all that, but let's start with first your current take on the overall commercial real estate market. Where do you see opportunity? What has really changed since COVID hit?
Yeah, so I think, if you separate out the asset classes, multi and industrial have done really well. Office is kind of in the middle, and then you have retail and hospitality at the bottom. So I think for multi, it kind of reset everything a little bit. It was definitely getting a little frothy with regard to potential rent growth and value add deals and whatnot. So I think it basically reset expectations a little bit. And people are obviously curbing their plans for rent growth. Industrial has held very strong throughout. Office is kind of like a wait and see type of thing. People are not sure what's going to happen, but there is still deal flow. Retail is pretty much at a halt right now until tenants resume. But, in general, neighborhood tenants are going to still need to be there, and grocery stores are doing very well now. And hospitality is falling off a cliff and probably will continue to do so for some time. So, overall, it was a correction that needed to get done, and it hit some of the food groups a lot more than others.
Yeah, interesting. So, and a point about what you said about the reset and multi, we've seen some price declines, but it's been in those markets that were already, in my opinion, overextended, right? Markets that we felt were overpriced by 10%, and then the price came down by 10%. So now it's just more in line with the relative pricing across the market. So we still haven't seen, at least we haven't seen, really attractive discounts on deals that would make us want to jump all over them.
Right. I think what you're seeing right now is you're seeing sellers that want pre-COVID pricing that don't really have a reason to sell unless they hit their pre-COVID values, but which is obviously going to be a disconnect. You do have some fund and institutional guys that have, a friend of mine has a fund that they've had out since 2015, and they have one more deal left in the Southeast, and he's like, whatever, if we take a discount, we're still closing the fund no matter what. So you do have some sellers out there, but they're mostly institutional driven. The private guys are going to say, why should I sell now if I don't have to? And, because collections have been so strong in multi, then there's no impetus to force a sale. So
definitely. So because you see potentially more, not necessarily distress, but reason to sell on the institutional side, are you seeing larger deals take on bigger discounts and the smaller deals trade with a tighter bid to ask, or not?
So you're not seeing any institutional deals really happening. All those guys are kind of put a pause on it until capital starts kind of flowing back into deals. On the smaller deals, though, you're seeing, syndicators want to do deals. So that's how they earn their living. So they're going to buy. So, the agencies have been very strong with, filling the gap and holding true to their position, providing liquidity to the market. So you're definitely, which is fueling the buying. So agency debt is super cheap. So it makes most deals work on paper. And as a result, guys are buying. So we're seeing a lot more in the last 3-4 weeks, bridge loan requests for acquisitions where deals are not fully stabilized. And they're getting some discount, probably 5-7% off pre-COVID numbers. So they feel that's good enough. And, it's transactions are happening. But yeah, as you said, on the smaller side, I would say is where most of the deal flow is happening.
Definitely. And on the bridge side, I know we're jumping around now, but on the bridge side, spreads gapped out. And for us, it seems like a bridge play is almost impossible to do just because of where underwriting is with bridge deals right now. I mean, from your perspective as a lender, that's obviously a good thing, but it seems like a 5 or 7% discount, like you said, is not enough if I have to underwrite to, a 70% LTC deal at L plus 550.
Right. Yeah. I mean, pre-COVID, you had bridge loans that were tighter than agency financing. So everyone would just go bridge because you have optionality. You don't have the lockouts. You have more of you have more flexibility. So, whereas pre-COVID, you had, the average bridge deal is L275 to L350. That space is totally gone because all those guys were selling them in CLOs, and the CLO market is non-existent right now. So you basically have a very barbelled spectrum. You either have agency debt for stabilized assets with a lot of demand, very cheap financing, 3.5% money, or you have bridge financing, which is going to be 7-8% money. So it better, as you said, it better be a good deal in order to carry that kind of debt. In addition, it requires more equity. Whereas I would say pre-COVID, guys were doing 75, 80, even 85 LTC deals. You're at pretty much 70 now, so maybe 75 on a stretch. So it's requiring more equity. It's wider rates. So yeah, it should be cheaper pricing, but it's not cheap enough probably. So, which is why for our sake, I'd rather be a lender in this space than the equity in this space.
Yeah, that's what I've been hearing from a lot of people that run multiple products. They're just really leaning into the credit side, seeing a lot of opportunity there. So that's an exciting thing. So
Yeah,
to
it's
look
much
deeper,
easier than to call someone every month and say pay your mortgage than actually have to deal with owning a property. So
right?
it's not that fun once you do. So
Yep, exactly. And when the returns are pretty similar on a levered basis, that's an easy choice. So let's break down, FM's bridge platform and understand why you guys took a pause because, uh, you know, the CLO lenders, understandably, their securitization market was frozen. They didn't want to hold, those loans on their books. So, what was the reason you guys paused and then why did you decide to turn back on?
yeah, I mean, for us, I would say we were pretty much financing all asset classes prior to COVID. Right now, we took a pause to see, one is what was going to actually happen. No one really knew. I know on our portfolio, when we were projecting collections in March for April, I was expecting 50% collections, and we were all pleasantly surprised. And even May, we were expecting lower collections, and they've been very strong. Hopefully they continue as unemployment still is going to burn off, but we'll that remains to be seen. We took a pause also to basically kind of our warehouse facility also paused us. So as a result, we took a pause. Right now we're pricing, let's say 7-8% money, which is kind of that intermediary space between a bank and a hard money lender, which is a space that we really like because we believe we can add some value and be nimble and flexible. But without leverage on our loans, we're going to have to be at 12 to 15%, which is not interesting for anyone. So there also weren't really transactions happening for, everyone just kind of got frozen for a couple months. And now it seems like things are starting to, regardless of the fact that numbers are maybe going up, but it seems like people are definitely still starting to get out there, starting to buy. We're getting loan payoffs from deals being sold. So things are happening.
Got it. So I want to go back to something you mentioned earlier about, really cheap agency financing, making deals look good on paper. And I want to know how you look at a deal to discern whether that deal is actually a good deal or just a deal that looks good on paper fueled by cheap debt.
Right. So, I mean, for us, and coming from the debt buying space, for when we used to buy a lot of default and multifamily loans, 2010, 2011, 2012, right? You're just basically, you have no financials. You probably can't even walk the property unless, you're not really supposed to walk the property. So you're just kind of guessing. You drive by it, you're like, okay, it looks fine. And then you realize it's not so fine once you get behind the walls, but nevertheless, you're just buying on basis. So, that's the way that we underwrite deals. It's just how much a door is it? How much are comps per door? And we'll kind of take the worst case scenario in the market. And that's kind of what we're assuming. So, if it's a 50,000 a door market, a guy's paying 70,000, that's going to give us pause, even though it might be upgraded and it might be on the yield might be very attractive and maybe the cap rate's attractive, but you're the highest guy on rent. That's scary when things turn away and rents can't get, raised anymore. And then you have collection issues and, people lose their jobs. Those are the first types of, places to go down. So, we're looking to lend on basis. And, as a sanity check, I would say we're at like 20. I was kind of expecting that we were going to go back to 2014 pricing. I was wrong. I think we're probably going to go back to 2016, 20, somewhere like that pricing. So where deals traded there before they went real crazy, that's kind of what we're kind of looking for. So.
Yeah, I mean, 2016 values with the level of, the cost of debt today, that would be some attractive deals. So
Right. Yeah, it's
that makes
a
sense.
true, low to mid six cap on deals. Obviously, in secondary and tertiary areas, I'm talking about, not necessarily in core areas, but I think, I think we'll see some dislocation, but the main thing that's going to be an issue is people are just not going to be able to raise rents. So if you have bridge loans that was your business plan and you're not able to alter the business plan, or your lender's not able to alter their business plan because they securitize a loan, then you're going to have some issues down the road.
Well, let's talk about distress. I know by this time you probably thought there would be some distress and some
Right.
opportunities. So what is your new take on distress across the asset classes and maybe also geographies?
Right. So, obviously you can find as many hotel distress loans as you want soon, but the question is, where's the bottom there? It's a hard thing to judge. You're not seeing much distress now because a lot of deals either had interest reserves or lenders forbeared. We currently now on our book have about 45 assets. We have one that's not paying. That's a hotel. That's it. And they basically are opening next month and will start resuming payments. So, for a bank or from a lender that has a lot more assets, they've pretty much given 3-4 month forbearances for everyone. At a certain point, it's going to have to catch up where if you're a bank, the regulators will eventually come in and force you to reserve against it. So a typical example that we give is, if you have a loan for $10 million out to someone and it's considered what we would call subperforming, which means they miss payments, they catch up, they miss, but they're down a couple months, their occupancy doesn't cover based on the debt service coverage. So it's considered a subperforming loan. The regulators would come in and say, okay, on that $10 million loan, we need you to reserve X amount of cash against it. So let's say it's $1 million of cash against it. So by that same token, the lender would just say, okay, I'll sell that loan at 90 cents instead of, and then I don't have this headache at all. I already have to use the cash. Might as well just take the loss. I don't have to deal with this asset. And, that will happen. That will probably happen towards the end of the year. But it's basically when it comes to banks, when it comes to the CLO market, it's going to be a little tricky because these are all securitized and CMBS even, CMBS, if they don't like you, then they'll start defaulting you now. If they like you and you have a rapport with your CMBS lender, which is very hard, which means you really need to be one of the bigger guys, then they'll work with you, but eventually they're going to force you to do something. So, year end, we're expecting some distress, but we're not expecting blood in the streets. So, unlike last cycle, was probably our fault. It was the banker's fault. It was Wall Street's fault. It was the buyer's fault. It was just over leverage. This cycle has nothing to do with anything real estate driven, and people are still very attracted to real estate. A mortgage is not toxic like it was last cycle. So it's a little bit different with investors still out there.
Right. And all this dry powder that's just been building up now from everywhere else.
Yeah. So guys are going to get, they have the money raised, they're going to buy deals, whether it's distressed or they call it distressed. There's deals that are going to transact. The CMBS guys are going to sell their debt because they have to. That's just the way that it works with their pooling and servicing agreements. So they're going to put it on 10X, they're going to put it on Real Insight, and they're going to trade their debt. So, because that's just the process, that's what happens when you get into a CMBS loan that doesn't perform. So
I want to go back to the basis point you made earlier, and just, one deal that came to mind is a deal we looked at in a, secondary / tertiary market in Texas, where it's got a floating rate agency debt on it that obviously it had no floor, and now LIBOR's at 0, and the debt's less than 2%, and so the cash flows look great, but the basis is really high, like you said, and it, so you have no exit, but you could get in and you could get double digit current yield. So those are interesting deals that don't make sense, but on paper you could potentially get attracted to, especially if you're willing to look the other way on the exit cap. But I bring this up because we want to know, is basis only a disqualifier on a deal, or can good basis really make you want to get into a deal, even if on paper it doesn't really stand out that much?
Yeah, I mean, for us, I care less about what the yield on cost is for the first couple of years, and more about the basis. So it's okay if it takes a little bit of work for the first few years in order to do it, because I think what it does is it separates you from other buyers out there that syndicate. Most syndicators are going to the average person and they're saying, okay, I'll give you a 10 to 12 coupon every quarter, and people are happy to get that, and they own real estate, and there's some depreciation, so it's a home run for the average investor. Do they realize they just spent $20 million on a property that's probably worth 18? No, but so what? They're getting their yield, so they're happy. For us, we like to be the cheapest on the block in general, because I always say we're very average managers. So we assume that we are going to do exactly as good as the previous owner. So maybe the market will, on some deals we have, our rent growth has been astronomical in Florida and a lot of places pre-COVID. We had stuff in Orlando and down here in South Florida, and our rent growth has been unbelievable, 6-10% year over year. Nothing to do with us. It has to do with the fact that we bought it cheap. The area, we picked the right area, and the area got better, not necessarily us. So it's very hard to put yourself in a situation where you need to add those granite countertops, or you need to make those stainless steel appliances to get those extra $50 so that your business plan works. People do it. You have to be very systematic, very organized, and really, and there's a lot of pressure. So, debt is great on leveraging returns, but a lot of debt is very scary. So, it's great when things are good, but when things are bad, you see what happened in this environment, where there was just a big liquidity crunch with lenders, and every lender leveraged their position. And if you didn't have good relationships with your lenders or liquidity lying around, you were in big trouble. I mean, TPG was a big, they had to basically get a big infusion from Starwood, or else they were going to go to zero. So there was a few other of those guys out there, but leverage is your friend in good times, but not your friend in bad times. So
makes sense. So I want to talk about you mentioned Orlando and things like that. And so where do you see opportunity for, we'll keep it to multi and hospitality in terms of what markets you think are going to have the most opportunity going forward?
Yeah, I mean, for sure, hospitality, you're going to see a lot in Orlando. What we're actually starting to see a lot of now, and we've seen a lot of loan requests in this. We haven't done any in this arena, but we're seeing a lot of guys that are deconverting their hotels into multi. So they're changing the zoning. They're basically, they're taking their whatever 500 unit C-class hotel that was running at 65-70% occupancy, and they're at zero now, and they're converting it to multi. Some guys are doing it the right way and breaking walls and making bigger units. Other guys are doing it probably the wrong way and just taking their 250 square foot units and putting a little stovetop in and trying to rent them out. So we're seeing a lot of that, and there's definitely going to be opportunity to buy a lot of these busted hotels in Orlando because there's tons of them, and the economy there, will come back. So that's an interesting space. And with regard to multi, it's tough to see. I think it's not really going to be geographically driven. I think it's going to be just deal driven, where you have specific situations that that are causing where people have a lender that's impatient, or deals that are undercapitalized, or deals that they haven't executed their business plans. So we're seeing in general, obviously, and as I said, I'm thinking New York City is probably going to be one of the worst. So just aside from that, you just have population leaving New York, and I think you're probably going to have, I guess, the most opportunities, but a lot of pain and blood in the streets of what, between all the regulation that's going on there, and all the everyone's leaving New York to down here in Florida, to Texas, to the Carolinas, to basically anywhere but New York. So you're going to see some pain over there. So.
Yeah. So how would you shift your multifamily acquisition strategy? You said it's very deal driven. So is the type of deal changing, like longer hold period, different debt structure, your bid to business plan, or is it the same thing? You're just looking for the right opportunity?
Yeah, I mean, I think it's being patient. Patience is, it's hard because it's boring, and nothing gets done, but you have to keep just grinding it out and going through as many deals as possible. And eventually the right opportunities will come out. If you're buying it at the right price, at the right basis, long-term, you'll be okay. I do think that people need to adjust their expectations for cash on cash a little bit, because I think, deals are going to struggle with rent growth a little bit for a while. I don't think we have rents that are going to be increasing anytime in the near future. So, as a result, I think, the days of levered 12s or 10s are going to be probably more like 7 and 8, if you're being honest with yourself. But long term, I think multifamily seems to be a strong asset class, and especially workforce housing area, as opposed to the Class A, the Class A space, which is a whole different discussion.
So let's finish it up on that similar topic, talking about Class A and development. So what's FM's experience and interest in development, and then how do you look at that from a replacement cost, build versus buy, and those types of things?
Yeah, so we've done a couple development deals, and we're retired from development forever. So it's just not worth the headache. We're not that good at it, honestly, and it's all timing in the market. So if you're building early, you're a genius. If you're building late, you're dead. So it's very cyclical, and at the end of the day, Class A is very hard, because especially now, in order for deals to work with land costs rising and construction costs rising, it's very hard to make deals work because there's a big flight now to the suburbs. Everyone was building urban core, and now no one wants to live in urban core. So everyone wants to buy a house. So you are losing a lot of people to home ownership, and you're not going to be able to really grow rents. So it's really going to be, there'll be opportunities in the Class A space, I think, to buy deals that are just going to be a cap rate where maybe they were trading at a 4.25 cap, where now they'll probably trade at 5.25 or 5 cap. And that's an interesting space because the yield is great, but you are going to have to release the property every year because your retention rate is not going to be there, where people are going to go buy homes. So it's
Do you think that's a long-term trend in terms of people leaving the cities? In my opinion, I think that thesis is still really strong for the cities, but just maybe right now for a year, 2
yeah,
or
right.
3 years even.
Correct. I mean, we see like mortgage applications soaring. Mortgage rates are obviously really cheap, and people just want space right now. I'm assuming that that will change over time, but I do think like if you had micro living or co-living or any of that kind of stuff, and that's going to be really hard sell right now. Apartments will stay, but a lot of these really small units, I think people are just in general going to want more space. So.
Definitely makes sense. And the other thing about developing in the suburbs is you have, less of a moat to new supply.
Right. Yeah. I mean, it's when it relates to replacement cost, we always say, one is when a broker's telling you it's below replacement costs, then you're a sucker probably. And then number two is some things just don't need to be replaced. So sometimes they just shouldn't have built it. So the problem is if you go to a lot of places, especially tertiary markets, land is free, basically. It's the cost of zoning, it's the cost of site plan approval. So, and then most of the time, especially when you're dealing with the Southeast or whatnot, Texas, you're building with sticks. It's all wood construction. It's very cheap. Florida's a little more cost prohibitive because you need concrete, you need impact windows. So there's a barrier of entry. But when you're building with sticks, sometimes it just shouldn't be built. So there's just not necessarily a demand, but developers will build as long as lenders will finance. That's just the way the business works. So once the lenders put the kibosh on lending on construction, then construction will stop. If they don't, then they'll keep going.
As Confucius once said, when money is available, builders will build.
Yeah, exactly.
Yeah. Okay. Well, really appreciate your time and getting to
Thank you
talk
very
about all
much.
these different topics. So, yeah, thanks again for coming on the show.
Very good. Thanks a lot. Take care.